Happening. It is the 4th of March, back in the Missouri office for the week, and I am looking at the market, and we've had today kind of some interesting movement in the bonds. Yeah, the ISM manufacturing came in damn near flat, slightly low, but not far off of where they were anticipating it to go. Then you've got construction spending is down from where the anticipation was. Again, not a ton, but it's still down. So we also have, with the jobs reports coming out this week, got a lot of movement in the market. We got the stock market just getting hammered. So money had to flow somewhere. It flew right into bonds and then flew right back out. So we're not seeing a whole lot of positive movement in the mortgage-backed securities. We're just seeing the bonds get yanked all over the place, which is good. We want to see some positive movement in there, but as you can see, we're hitting these barriers and pulling right back off it. We literally went right up to the main barrier that I always point out, which is that the day they start quantitative easing, and of course the end of the day during quantitative easing, this is that big ominous barrier. We hit that thing and pull right back off of it. So I don't know that we have a whole lot of steam to get there, even with all that's happening in the stock market. And so you have all this weakness in the stock market. You have a lot of people wanting to leave it. There's a lot of uncertainty because of the tariff situation. But once it settles into it and they start realizing, tariff is really just it's a business negotiation tool. Ultimately is what it is. Once we get there and people settle in, we might start seeing the money flood back. So, and especially when we now have that barrier above us that I was just showing you with mortgage-backed securities, it starts to flood back and you start to see money go back into the stock market. That's going to be a hammer on those bonds. So we'll just see how this all plays out. I can't say one way or another. I know we locked some loans over the last month. We haven't seen enough movement in the bonds to warrant any sort of float down. I know we have that floating out there as something we can use as a tool for those who are really, really concerned about where the rates are going. But let me tell you, I don't concern myself with them. I lock it, I move forward. That's it. Lock it, go. Now, if the rates drop significantly and we alert you to that, then okay, cool, take the flow down. But if it hasn't happened, don't worry yourself about it. Don't stress yourself. Am I going to get a flow down before I close? Don't care. Just go. Get done. Make sure you run the numbers, that the deal is going to pay for itself, and you move on to the next deal. That's how we go about business. But I got something really exciting about the business aspect that I think would be very, very good for you to know. If you run into some 2 to 4 units, because I know those do pop up, and they are, they're higher priced these days, but they're also higher rent. Your total rent is going to come in it's in the DSCR world, a great ratio. You're in your debt service coverage ratio, meaning you got your debt that you're paying, principal, interest, taxes, and insurance, and then the income that you have exceeds those expenses. That means you have a positive debt service coverage ratio. If it's below those costs on a monthly basis, you have a negative debt service coverage ratio. We want to see that over 100% of it, or it's what they call, like we usually price it at 1.2 DSCR, which would be roughly, if you had $1,000 a month payment between the principal, interest, taxes, and insurance, and you had $1,200 a month in income coming in gross rents, that's approximately a 1.2 DSCR. Slightly off of that. You're off by a couple of bucks when you really do the actual numbers. But what's cool about that is something that everybody keeps asking for. We can get an 80% loan to value 2 to 4 unit DSCR. Now, 80% for 1 unit, of course, we can do that. Single family always was getting 80% loan to value with Fannie and Freddie, but we can go to 80% with the DSCR 2 to 4 unit. What's even more significant, I priced this today, right? We had the right debt service coverage ratio, 780 plus credit score this guy had. He did a comparison. Hey, I want to buy the property with a conventional loan, ran the number. And he goes, do you do 80%? It's like, we don't. But I tried it on our thing just to see, and it popped up at one of our DSCR products had an 80%. So I did some looking, it literally offered it. So I priced it for him. Now get this. This is over a $300,000 purchase price, pretty good sized loan amount on the 2 to 4 unit. This was actually a duplex. The 80% loan to value DSCR product with a 1.2 DSCR. It could, I know it can range. It could be, 100, 1.5. There's a big range in there, and it does affect your price. But his scenario on that 1.2, the interest rate was actually slightly lower than a 25% down conventional loan. So wrap your head around that. If you're considering buying an investment property right now, you really should consider the DSCR. You should really contact me and let's talk about this, especially if it's a 2 to 4 unit. So right now we're seeing those rates really, really competitive. There's another reason why you should be considering this. How long have you wanted to be able to get loan to your LLC? Now we got it for 30-year fixed. Sure, it has a prepayment penalty, but you shouldn't be refinancing that damn thing for 5, 6 years anyway. I never refinance unless I'm pulling enough cash out to buy a couple more properties. Otherwise, it's a waste of money and time and energy. So call me. We'll talk it over. 602-291-3357. Just text me. We'll make it happen. Appreciate you guys.